So it's a tactical trade. I sold gold because gold doesn't like when growth and inflation are accelerating. That is what I expect to happen, because there's other alternatives. You can buy stocks when growth is accelerating. Bond yields are going higher, so that's an alternative. It's competition for money. Gold is real money, but that process could end in an absolute disaster. And the fact that inflation is above the Fed's target, rising, you're going the wrong direction. It's actually rising from 2.5% and going higher. And Susan Collins says, well, if you take out like the stuff that you need to live, like energy, food, and shelter, we're good. This is how out of touch they are.
In today's news recap, silver dips under $30 but recovers quickly. JP Morgan analysts suggest the sell-off is short-term and the debasement trade rumbles on. Silver prices dropped below $30 an ounce during early trading on Thursday morning, influenced by market volatility and investor reaction to macroeconomic factors. However, prices bounced back following the release of the United States Producer Price Index data, which revealed a rise in prices and hinted at a slight increase in inflation for October. This data underscored concerns about persistent inflationary pressures affecting global markets. Precious metals have been trending downward in the wake of the U.S. election, which saw Donald Trump set to return to his previous post as president. This political shift has contributed to uncertainty, prompting mixed responses in the financial markets. Gold, for example, traded within the $2,570 range Thursday morning, maintaining a delicate balance amid changing economic forecasts and investor sentiment. Reduction in supply. On Wednesday, the Silver Institute Industry Association provided insights into the global supply landscape. It projected a 4% decrease in the global silver deficit for 2024, driven by a modest 2% growth in supply offsetting a 1% uptick in demand. The Institute also forecasted a 5% increase in supply due to a surge in Western silverware scrap, which is helping to alleviate some of the shortfall concerns. Strength of the dollar. The U.S. dollar has surged in foreign exchange markets following Trump's election victory. His campaign, rooted in a nationalistic economic strategy, has spurred expectations of significant policy changes. This shift surprised JP Morgan analysts, who released a note on Wednesday indicating that the swift move lower in gold post-election ran counter to our strategists' expectations. However, they view this decline as temporary rather than indicative of a long-term trend. There isn't a break in the thesis that a Republican sweep of government will likely continue to fuel further upside for gold in 2025 as the debasement trade rumbles on, the note added. As markets brace for potential policy changes and evolving global trade dynamics, investors remain watchful of how these factors will shape the future of precious metals. Now we'll show you more clips, but first, smash the subscribe button and turn on notifications so you do not miss out on our recaps. Enjoy the episode.
Drop below the $1. There's no liquidity. Nobody wants, the repo market freezes. So nobody, even repo as a collateralized lending. Nobody trusts the institution that's lending them treasuries. I mean, that's happened before, and I think it's going to, in fact, I can't guarantee it, but I'm very confident it's going to happen again. And that's when things fall apart. That's when the Fed has no choice to. I don't care what they say. I don't care what inflation's doing. They have to reliquify those money markets. Otherwise, you're talking about a depression that, it's an existential crisis for the nation. If you can't float commercial paper, if the liquidity dries up and this repo market is frozen, nothing works. No lending, zero lending in a fiat currency system means that the economy goes to zero. Forget about a recession. You're talking about a trenchant and powerful depression. So no, there's no choice. That's what they're going to do. And that's when you're going to have to, if you're in that 60-40 buy and hold portfolio, boy, oh boy, it's not funny. Prior to the GFC, that includes everything. The Thai baht crash, Russian crisis, 2001 debacle, everything. 87 the Fed's balance sheet, which is high-powered money, basically representative of high-powered money, represents the base money supply, the building blocks of all monetary aggregates, was $700 billion. That base money supply went to $9 trillion post-COVID. It was $4.5 trillion prior to that. Jerome Powell printed $4.5 trillion for what turned out to be only like a slight decline in GDP, I'm not going to say I'll say an exaggerated crisis, a health crisis. Okay, exaggerated. It wasn't nothing. People died, and I feel terrible for them. But it wasn't, it wasn't the end of the world. It wasn't the bubonic plague. We can agree on that. Okay, I hope. But they shown a willingness to expand that balance sheet willy nilly in a nanosecond by trillions of dollars, and they're going to do it again. And who's going to buy all that debt? I mean, where's it going to come from? It's going to come from the Fed is going to create credit, and private banks are going to go out and buy it all. And that's massively inflationary. So it's a tactical trade. I sold gold because gold doesn't like when growth and inflation are accelerating. That is what I expect to happen because there's other alternatives. You can buy stocks when growth is accelerating. Bond yields are going higher. So that's an alternative. It's competition for money. Gold is real money. But that process could end in an absolute disaster once you get a freeze in the credit markets, and then you could have a wipeout of everything. And then people will be, oh my gosh, we're going back into helicopter money? Really? And I wanted to just button up that point because from 87 to the global financial crisis, even to the COVID crisis, the Fed came to the rescue by printing, like we just talked about, trillions of dollars. Because the problem was what? It was, we had disinflation, we had deflation. We haven't had a problem with inflation since 81. Well, now we've got a problem with inflation. And now we have insolvency in the treasury market. So what you're saying is that the Fed put, what people are saying is Wall Street, not me, Wall Street's telling us, well, the Fed has your back. They've inculcated this over and over again. The Fed has your back. In a problem, they will print trillions of dollars. But what if they print trillions of dollars when the problem is the salient issues are insolvency and inflation? They're going to just make the situation much worse, right? So you could have negative real interest rates, profoundly negative real interest rates, even though nominal rates are spiking. That's the best environment for gold. So gold likes two things. It likes recessions because nominal rates are falling. Generally, real interest rates are falling. There's less competition for other assets because who wants to buy a house or a stock or buy bonds, short-term bonds, when the rate's coming down, you buy gold, right? And gold loves stagflations because that's when you have no growth or negative growth and you have high inflation. So how do you keep ahead of inflation in that scenario? You have to buy gold. And that's where I think we're headed in the long term. So again, I said it this is the third time. I won't have to say it again. It's a tactical move for those active managers. But if you're not worried about short-term moves with the gold price, then stay where you are. Setting some of the tax cuts and deregulations that you're going to have. I mean, we still have a tremendous amount of debt. The household has a record amount of debt, not as a percentage of GDP. That's come down from 100 to around 70%. But 70% household debt to GDP is very high. We have a record amount of corporate debt. We have things like private credit out there, which didn't even exist before. Trillions of dollars of this stuff. Commercial real estate. These are all things that are affected by higher interest rates, and higher interest rates are going to be a massive depressant to offsetting what I just mentioned, the Trump election. And it could get out of hand. It could spiral out of hand because, if you have, and this is the three reasons why, these are things that Powell and Susan Collins, who, we're data dependent. Well, you're data dependent. I just wrote a piece called Driving the Interest Rate Vehicle with Your Feet on the Steering Wheel and Your Eyes on the Rearview Windshield. That's what they're doing. I mean, they're making decisions about interest rates that should be based on a free market. It should be based on a gold standard. They're making decisions looking at data that is lagging and faulty. The data is faulty on what? The labor market. That's how they're making their decisions. In my opinion, we should have a money supply that's dictated by the mine supply of gold. That's the base money supply. You should have a fettered fractional reserve system where you can't go out and just monetize debt willy-nilly, but that's what's going to happen. You're going to have the banking system, both shadow and traditional, FDIC insured institutions, monetizing trillions of dollars of the federal debt, which is going to be bought by Jerome Powell. He's going to be forced to do it. The average interest rate on U.S. debt is about 3.5% right now. There isn't an interest rate on the yield curve. You go from Fed funds all the way to the 30-year. It's much higher than that. So the interest on the debt, which is already $1 trillion, is going to go much, much higher because the debt's going higher and the interest paid on that debt is going much higher. We're already paying 20% of interest. 20% of all revenue is going to pay interest on the debt. That would be 30% today if we had interest rates normalized. I mean, if interest rates stayed where they were and we just kept on floating T-bills. So why are interest rates rising? Inflation, insolvency, and illiquidity. That's why you'll never hear Powell or Susan Collins talk about that. That's the real problem. And that's what you have to monitor if you're investing in the stock market. And I'm still not sure. Then again, I am still not short yet. I'm waiting. If financial conditions continue to ease, credit spreads remain very tight, and we have the promise of lower taxes, much lower taxes, across the board, on corporations, on individuals, Social Security, taxes and tips and everything. I mean, he could get a lot of this passed. I don't know how much he's going to get passed, but he could get a lot of it passed. And deregulation is going to be massive. So you're going to get a big increase in money supply. So inflation is going to be much higher than I thought it was going to, or not that I thought, than what it could have been under a Harris regime. So you got to watch the credit markets, and that's going to lead you to a path of, being able to invest responsibly and carefully in this bull market that continues, or to get completely wiped out. This could be a 1987 event. By the way, Jonathan, do you know the total market cap of equities? This is Warren Buffett's favorite indicator, and it's my favorite indicator too. The total market cap of equities as a percentage of the underlying economy in 1987 was October of 87. Do you know? It was 60%. Do you know what it is today? It's over 200% of GDP. That tells you how incredible the bubble is in equities. And that's why, like I said, if you're just and everybody's in it, there's a record amount of investors that own stocks right now. A record amount of household net worth is in the stock market. And they're all crowded into the same few stocks. When that unwinds, it could be catastrophic. I mean, in 1987, we lost 23% in one day. That can't happen again. And the reason why it can't happen again is because we have circuit breakers, right? 7% down, we close down for 15 minutes. And then we go down 13%, there's another 15 minutes. And if you close down 20%, we shut the whole thing down. But does that make you feel what, because that's giving you any dollars? No. Really. No. So the operative word here is caution, stay alert, have a model that works and monitors the credit markets, because you could get slaughtered even though things look okay right now.
In today's analysis, Michael Pento discussed his strategic move to sell gold amid expectations of accelerating growth and inflation, which often lead to alternative investments like stocks and higher bond yields. He highlighted that while gold is real money, rising inflation can increase competition, making gold less attractive. Pento warned about potential credit market freezes and liquidity crises that could force the Federal Reserve into drastic measures like money printing, risking a severe depression. This scenario would make gold valuable long-term, particularly in cases of stagflation. Meanwhile, silver's demand remains strong, driven by industrial needs, even as investment interest fluctuates.